We have a quick question here about the moves that we're seeing today in the market, especially in gold and silver. And I think this is a great example of why patience is so important when it comes to trading. Now, as you all know, we've had a great run in both gold and silver recently, with both of the two metals gaining considerably over the past few weeks in sessions. Silver having a few days of back to back gains of between 5 and 6%, just as an example. Now, even though the fundamentals certainly supported these moves to the upside, there was no doubt that that last few pushes, those last few sessions we had to the upside, was largely driven by FOMO, with the fear of missing out taking hold of traders, with traders basically leveraging up and trying to get in on the move that they already missed, or a large part of the move that they already missed. And the problem with this, of course, is that it often causes the market participants to chase moves at highly stretched positions. And with leverage, that becomes a very dangerous game. You see, with these types of FOMO moves, the fear of missing out on another move higher is enough to let people jump in at a high leverage, at the highs or at the lows, hoping to just quickly bank a quick buck. And today's price action and yesterday's that we saw in gold and silver shows us why this can be so dangerous. And from a fundamental point of view, yes, you want to be long something like gold, but you want it to be long from a while back already, and that's the point. If you weren't long from a better price, you seriously need to ask yourself where you think there is still value getting back in this type of move. And basically, in terms of the balance of probabilities, am I buying into something that has a bigger probability to move further from here, or a higher probability to correct? And there were many traders, who felt like they missed the move in gold and silver recently, and on Friday would still have felt bad that they missed most of that push to the upside, the recent one um, that we've had in gold and silver. And often the FOMO can lead us to think that, there's never going to be a pullback ever again. The market will just continue moving higher without ever correcting. It'll just go up in a straight line, basically. There are, of course, reasons for gold to go down today from an intraday cross asset correlation. We've seen this line in the blue is the inverse of the bond yield. We've seen US bond yields just absolutely rip roar to the upside. So there is a reason, of course, why we're seeing gold react the way that it has in today's session. So no doubt there's a short-term reason for it. But apart from the intraday reason for the move, the point is that the move or the correction we are seeing was well overdue, apart from bond yields moving higher. So apart from yields breaking out to the upside, the correction, this was something that was way overdue for gold as well as silver. So the next time when you're faced with a decision to buy into or sell into moves that's already moved parabolic in the market, just take a step back, do some additional research on whether this right now is the best time to re-engage the market, or whether there's more value to wait for a potential correction. And of course, there's going to be some times when you don't get that pullback. There's going to be sometimes that the market moves without you, but that's okay. In those cases, rather miss out on a move than jump into something where the risk to reward just doesn't make any sense anymore. So I hope that helps with your question. Any others, please don't hesitate to let us know.